Look, here's the single most devastating financial shock that crushes people right at the finish line of their career. You've done everything right. You diligently saved in your 401k for 30 years. You retire with a massive seven-figure balance. Let's say $2 million. You feel invincible. Then you start withdrawing the money, and the government hands you the bill. Every dollar you take out of that traditional 401k is taxed as ordinary income. You realize your $2 million nest egg is actually a $1.5 million nest egg, and you're now paying the highest tax rates of your life, all because you didn't manage the tax bracket ladder correctly. You successfully saved the money only to lose a massive chunk of it to the system. That's just the first trap. The tax code is not just complicated, it's a field of landmines waiting for the unprepared investor. Today, we're diving into the obscure but powerful rules that determine whether you keep your wealth or hand it over to the government. The tax bracket ladder, the simple, strategic blueprint to pay less tax when you retire, and how to get money out tax-free. The power of NIL money, the obscure finance rule creating a new class of young millionaires, and the powerful lesson it holds for your income, the $1 rule, the crazy minimum tax loophole corporations exploit to save billions, and how to copy their mindset. My name is John, and I spend way too much time thinking about how the government systems are designed to extract wealth, and the legal strategies you must use to protect it. If you're someone who feels like you're finally making good money but losing too much of it to Uncle Sam, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Let's expose the system. Part 2. The Tax Bracket Ladder. How to pay less tax. When you retire. Look, most people treat retirement planning like a sprint to the finish line. Shove as much money as possible into the traditional 401k for the upfront tax deduction. Here's the thing, your future self might pay a much higher price. The psychology, the allure of the upfront deduction. The upfront tax deduction feels amazing. It's an immediate, tangible cash reward. This is instant gratification overriding long-term strategy. You save 24% tax today without realizing you might pay 24% tax tomorrow. Plus, you lose control over your future tax rate. The strategy? Controlling your taxable income. The wealthy don't just save money, they manage their taxable income year by year. They see retirement not as a single withdrawal, but as a series of controlled annual withdrawals designed to keep them in the lowest possible tax bracket. This is the tax bracket ladder. The core concept? In retirement, you have three primary buckets of money: taxable, traditional 401k/IRA, money you saved pre-tax, taxed as ordinary income upon withdrawal, tax-advantaged Roth IRA or Roth 401k, money saved post-tax, withdrawn 100% tax-free forever, taxable brokerage, money saved post-tax, capital gains tax only on profits, actionable step, strategic Roth conversions. The latter works during your low-income years, the years right after you retire but before you hit age 73 and must start taking required minimum distributions, RMDs. The gap. During this period, your taxable income might be very low. You can strategically convert money from your high-tax traditional 401k to a Roth IRA. The math. Let's say your taxable income is only $20,000. The government gives you a standard deduction, around $30,000 for a couple. You can convert another $30,000 from traditional to Roth, paying only the 10% and 12% tax rate on that converted money. The result, that $30,000 is now tax-free, And you have bypassed the 22% or 24% rates you might face later, especially once Social Security and RMDs kick in. Storytelling analogy. You are like a warehouse manager strategically opening doors to release goods, money, in small batches to avoid triggering a huge tariff, high tax bracket. You use the low, cheap brackets before they disappear. Part 3. The power of NIL. Money. The finance rule, creating young millionaires. Let's talk about the biggest, fastest financial shift in the youth economy. NIL. Name, image, and likeness. For decades, college athletes couldn't make a dime off their own fame. That was a system designed to extract maximum value from young talent. That changed with NIL. And here's the thing. The financial rules that created this new class of young millionaires are the same rules you need to apply to your own income. The finance rule, monetizing intangible assets. NIL money is the perfect example of monetizing an intangible asset, a personal brand, a following, or unique celebrity status. This is not hourly labor like a job. This is leveraged asset income. The old way, you got paid $50 an hour to teach a class. Linear labor. The NIL way. You get paid $50,000 to post one photo endorsing a product to your audience. Leveraged asset. The young athlete who understands this is not just playing a sport. They are building a media company based on their own value. They are separating the performance, the game, from the business, the brand, the psychology. You are a business. The lesson for you is profound. You are not just an employee. You are a business with intangible assets. If you are a great software developer, your intangible asset isn't just your code. It's your reputation, your network, and your ability to attract talent. If you are a great teacher, your asset is your curriculum and your authority. Actionable step. The separation principle. You must implement the separation principle in your own life. Identify your asset. What makes you uniquely valuable? Public speaking, complex problem solving, high trust network. Separate the labor from the asset. Stop selling your asset cheap for hourly wages. Start creating leveraged products, a course, a specialized consulting project, a high-fee retainer. Monetize the brand. Your next raise or promotion shouldn't be based on hours worked. It should be based on the value of the asset, your unique skill, reputation you bring to the table. The system changed for young athletes. You need to change your view of your own income. Part 4. The $1 rule. The minimum tax loophole that saves corporations billions. All right, let's talk about how the tax code is written for the powerful and how we can learn to think like them. We pay our taxes based on gross income. Corporations pay based on net income, revenue minus expenses. Every single expense is a reduction of their taxable income. This brings us to the ridiculously powerful concept that I call the $1 rule. The concept, leveraging the de minimis deduction. The tax code is full of obscure rules, but one of the most powerful for reducing corporate tax is the de minimis safe harbor election, or simply the de minimis rule. This rule allows a business to immediately expense, deduct, certain smaller costs, rather than capitalizing them, depreciating them over years. The law. A corporation can currently deduct items that cost under $2,500 per item, or even up to $5,000 if they have audited financials, immediately in the year they were purchased. The psychology. Expense everything. Here's the loophole that saves billions. corporations approach spending with the mindset that every single purchase, even if it's not strictly necessary, is a subsidized deduction. If a corporation buys a new computer for $2,499, they deduct that entire amount, reducing their taxable income by $2,499. If they are in the 21% corporate tax bracket, that computer effectively costs them only $1,974. The government subsidizes the rest. The $1 rule is the mindset. For every $1 spent on a legitimate business expense, you reduce your taxable income by $1. The lie: most small business owners or freelancers only deduct the things they have to: rent, salaries. The corporate truth: they strategically push spending up to the deduction limit on things that also improve efficiency, like new software, small equipment upgrades, or even client entertainment, knowing they are getting a massive government-subsidized discount. The math: the true cost of capital. Let's look at a small consulting business. You need new chairs for your office. Chair cost, $2,400. Tax bracket, 22%. Federal self-employment, state combined. Tax savings, $2,400 times 22% equals $528. True cost of chairs, $2,400 minus $528 equals $1,872. By strategically spending the $2,400 before the end of the year, you immediately save $528 cash on your tax bill. Actionable step: the year-end deduction audit. If you have any side income or run your own business, you must implement the year-end deduction audit. Project your taxable income. Look at your profits in late November. Audit your capital needs. Do you need new equipment, software subscriptions, or professional development? Spend to the line. Strategically make those purchases before December 31st, knowing you are effectively getting a 20 to 40% discount, depending on your tax bracket, on every dollar spent. Stop thinking of spending as loss. Start thinking of legitimate business spending as a subsidized capital investment. Part 5. Conclusion and motivation. So what did we learn today? We learned that the tax and government system is not a mystery. It's a puzzle with specific rules. Your financial success is determined by your willingness to learn those rules and use them aggressively. You beat the future tax trap by mastering the tax bracket ladder and strategic Roth conversions. You beat the wage ceiling by realizing your NIL potential and monetizing your intangible assets. You beat the high tax bill by adopting the corporate $1 rule mindset. Strategically expense everything to reduce your taxable income. The system is complex, but the successful strategy is simple. Do not pay a penny more in tax than you are legally required to. If you like this breakdown of the tax secrets, hit that like button. Let me know in the comments below. What is one purchase you're going to make before December 31st to leverage the corporate $1 rule in your own business? All right, we've covered the tax bracket ladder, the power of NIL, and the $1 rule. Now let's talk about the single most powerful yet confusing tool in the corporate tax world. And it's a tool you can use if you own rental real estate or any substantial business assets. The tax illusion of depreciation. Here's the thing. Businesses don't pay tax on their revenue, they pay tax on their profit. Revenue minus expenses. Depreciation is the magic accounting trick that acts as a massive expense even though no actual cash leaves the company. The mechanism, the non-cash deduction. Watch what happens when you calculate the taxable profit. Cash profit, $7,000. Depreciation deduction, non-cash, negative $10,000. Taxable profit, negative $3,000. You, the owner, put $7,000 in cash in your pocket from rent profit, but your tax return shows a $3,000 tax loss. You literally earned money, yet you paid zero income tax on it. You can even use that $3,000 phantom loss to offset other income you might have earned from your W-2 job, subject to passive activity rules, of course, but the principle holds. The psychology. Getting rich slowly, the tax illusion of depreciation, is why successful real estate investors can live lavishly, look financially poor on paper, and pay minimal income tax. They're getting rich through two channels: cash flow, tax-free, the money they put in their pocket every month; asset appreciation, tax-deferred, the building value increases over time. Actionable step, the tax zeroing asset search. If you have high income, you need a tax zeroing asset. This doesn't have to be a multi-million-dollar apartment complex. Even a small rental property, a piece of equipment for your side hustle, or a large capitalized business purchase can provide depreciation to dramatically reduce your taxable burden. The rule: look for assets that produce cash flow, but are legally allowed to claim large non-cash deductions. Finally, let's talk about the ultimate, advanced, and completely legal tax loophole that separates the millionaire from the billionaire: the debt for equity swap. You and I, when we need cash, we sell our stock. We pay the capital gains tax, 15 to 20%, and our compounding growth stops. The ultra-wealthy do the exact opposite. They never sell their appreciated assets. They borrow against them. The mechanism: non-taxable loans. When you take out a loan, the money you receive is considered debt, not income, and debt is not taxable. Scenario: Elon Musk or Jeff Bezos. They own billions in stock, equity, that has appreciated 1,000%. The fictional tax trap is huge. They need $50 million for a new mansion or a yacht. The poor way, our way. They sell $50 million of stock, realize a huge capital gain, and pay $10 million in tax. Their compounding stops. The rich way, the swap. They take out a non-recourse loan for $50 million using their existing stock as collateral. The result: they get $50 million cash to spend, they pay $0 in income tax on that cash, and the original $50 million of stock remains fully invested, continuing to compound. The psychology, the ultimate leverage. This is the ultimate form of leverage and tax deferral. They are effectively swapping their low-tax, long-term equity appreciation for tax-free, immediate cash flow. They pay interest on the loan, but that interest is often less than the long-term growth rate of the stock, and that interest might even be tax-deductible. Meanwhile, the assets they hold continue to grow, and they eventually pass those assets to their heirs. The step-up in basis loophole, where all the capital gains disappear completely. They literally live their entire lives off loans that are repaid by the future appreciation of assets they never had to sell. Actionable step: the portfolio line of credit. You don't need $1 billion to use this. Once your taxable brokerage account grows large enough, usually 6 figures, you can explore a portfolio line of credit, PLOC, from your brokerage. Get pre-qualified. This is a line of credit secured by the value of your stocks and bonds. Use it strategically. Instead of selling stock for a large one-time expense, like a down payment or a business investment, you use the PLOC. You pay interest, but you avoid capital gains tax and keep your money compounding. You must stop viewing your assets as cash you might sell and start viewing them as tax-free borrowing capacity you can leverage. That is how the wealthy manage their lifestyle. So, what did we learn today? We learned that the tax and government system is not a mystery. It's a puzzle with specific rules. Your financial success is determined by your willingness to learn those rules and use them aggressively. You beat the future tax trap by mastering the tax bracket ladder and strategic Roth conversions. You beat the wage ceiling by realizing your NIL potential and monetizing your intangible assets. You beat the high tax bill by adopting the corporate $1 rule mindset. Strategically expense everything to reduce your taxable income. You pay zero income tax on cash flow by leveraging the tax illusion of depreciation, and you can live off your gains without selling or paying tax by using the debt for equity swap via a portfolio line of credit. The system is complex, but the successful strategy is simple. Do not pay a penny more in tax than you are legally required to. You have the tools, you have the formulas. Now you have the advantage.